Alright guys, 30-year treasuries and T-notes. Okay, now some of my best concepts are found in my early days as a futures trader, and the bond market is a big market, and it provides so much insight and leading information. Now, I don't trade bonds anymore, but I absolutely monitor the futures on a daily basis. This market can tell you everything you need to know in any market asset class if you understand it. The scope of the bond market is not the objective here, but we will use it to discover some rather impressive techniques to ferret out some blockbuster trades. 10-year treasury notes. Okay, much like the 30-year treasury bond, I used these early on in my career as a futures trader, and there's a little caveat to understanding the bond market. Whenever you see the price chart on the futures, when they rally up, they will have inverse relationship. In other words, as the price data goes higher, the yield will actually be going down. So you have to have that in your mind. Now, since I trade the cable and the fiber exclusively, I trade tracking the German 10-year bond as well. The 5-year treasury note, much like the 10-year and 30-year, and when the price runs up on the contract price on the futures market, the yield will be basically decreasing or dropping. And obviously, if the chart would be dropping on the futures, that would mean the yield would be increasing as well. And much like the 10-year, I also track the 5-year German bond as well. And 2-year treasury note, much like the 5-year and 10-year, I track that on the German basis as well. And by having an understanding of all three of those, we can find some pretty neat things we're going to learn about here shortly. Obviously, it goes without saying, the US dollar index. I like dailyfx.com if you go to the NetDania charting. Now, do not go to netdania.com. Okay, it's very important. Go to dailyfx.com and use the NetDania charting. It's free. Okay, and just open up a US dollar index chart, and it'll give you, what I like to see in terms of the US dollar index. I look at the cash basis also, and the chart to the right here. This is the futures chart of the United States dollar index. If you like these types of charts and you want to subscribe to them, it's not very expensive. All things like $25 a month, but you can get that at pricecharts.com. You don't need to pay for futures charts, but I do prefer this format because I'm used to reading them since 1990s. I've just grown accustomed to having them in my repertoire. Now, I like to use SMT concepts to spot diverging highs and lows between the USDX and relative price points in the fiber and cable. And you know that as my USDX SMT, and I look for the bond and USDX SMT as well. Major stock market indices. Okay, the major stock market indices are one of my favorite tools to gauge long-term price swings. If we are failing at highs on the daily charts, as we see here in the image to the right, this suggests a possible risk-off scenario. Expect weaker stock prices and possibly foreign currencies. The US dollar index will confirm this with a rally at support at the same juncture. Simply reverse for risk-on scenarios. The markets as a whole are interconnected, and it pays to monitor them and hunt for clues. The CRB Commodity Index. Okay, now I usually watch this on the cash basis, and you can get that from the pricecharts.com. I'm sure if you do a Google, you probably find it as well. But again, I just really like this chart. I think it's real crisp, and when you print them out, there's nothing like printing out charts and marking them up by hand. I'm like a Flintstone caveman. I like being able to carve up some notes and draw over my charts. I like sharing with you guys electronically, but if it's going to be a matter of preference, I would love to have printed charts every single day. This is my opinion, really. Now, I like the CRB index because it usually has a inverse relationship to the dollar index. And I like to confirm a swing higher in the dollar with shorting fiber and or cable with a CRB decline. Now the CRB index tends to be a little bit early and can warn of possible long-term shifts in the trend. It's a dynamite tool to use for major market analysis and pinning down long to intermediate term directional bias. Alright, oil and gold. Now I like looking at these two markets. I don't trade them, but I'd like to use them as barometers more or less to see if there's risk on or risk off scenarios underway. And basically you want to be looking at the same way that foreign currencies and CRB, all of those markets should be moving in tandem with both. Okay, we're looking at the T-note yields. Okay, these are going to be the 2-year, 5-year, and 10-year. And you can look at the legend up here to determine which is which as we go through. And what I'm highlighting here is when there is a divergence between these yields, okay, these are T-note yields, and this line is not the T-note price, it's the actual T-note yield. So the yield is actually an inversion of the futures charts price of the T-note. Okay, so I kind of monitor both, but the yield, when you monitor it like this, it will basically mirror what foreign currencies should be doing. In other words, as the yields were increasing here, that would have been bullish for foreign currency, and contrary, as the yields drop, that would be bearish for foreign currencies. Okay, you see these confirmations in your technicals on your charts. In other words, if there's a buy signal for foreign currencies in your daily charts or respective time frames that you trade, and there is a sell signal being confirmed in the US dollar, that is a confirmation that you probably got a good probability of a nice swing for your respective time frame. Now what we're referring to here is a daily basis, so this is really going to give you a buy program or sell program. Okay, this is the beginnings of a buy program, and this is the termination of a buy program and a beginning of a sell program. Now the main thing as I want you to focus on is that there's typically a 3 or 4 month cycle. Okay, it's like almost like a quarterly effect that takes place in the yields, and it's based basically on interest rates and macroeconomics and things of that nature. But I'm not going to bore you with that here. But just basically, if you look at the charts and on a historical perspective, you'll see that that is in fact what happens on the average. Now what we're going to do is we're going to talk about, at the time of this recording, this is June 2012, and what I'm looking at is trying to go over why we saw the precipitous slide in the foreign currency market, namely the British pound and the Euro USD pairs, cable and fiber. And we're going to look at how that relates to these yields here. Okay, and what we're looking at again on this chart is the United States 10-year, United States 5-year, and the United States 2-year T-notes. Okay, and again, these are the yields. And basically what you're looking for is at specific times seasonally and quarterly, there will be a divergence that posts in these yields. And that looks like this. We have, it may be a little difficult to see, I understand, but the orange line here, which is the 2-year, the high made back here is lower than the high it made in March-April time period, okay, or actually in March 19th. The high here on the 10-year was just about equal, and same thing here, we have the 5-year just about equal. Okay, so we have a divergence between the 2-year, 5-year, and 10-year. Okay, that typically is a reason to start looking for other reasons to support a decline in yields, which would represent a decline in foreign currency and a rally in the US dollar index. Okay, so let's take a look at a few other examples, and we'll look at the foreign bond markets. All right, now we're looking at the 5-year notes on the UK UK's 5-year note, the German 5-year note, and against the United States 5-year Treasury note. Okay, and we're going to look at this same time frame in here. Okay, going back to this chart real quick just to reference again. We're looking at 2012 March April time period. Okay, we're going to go and look at this area here, and what I want to draw your attention to is the fact that we had the US 5-year note higher respectively, while the German 5-year note was lower, and the UK 5-year note was lower. Okay, and what I'm going to do is I'm going to take off the UK so you can see there is a clear divergence between the US and the German. That'll sufficiently show the divergence. Okay, you can see the high here. It's a high on the red line. That's the German 5-year note. It's bearish, while at the same time the US 5-year note was making a higher high in yield. Okay, and then you saw them slide together. That is a yield SMT divergence. Okay, as I look at it, you can see a contrary signal here back in October of 2010, where the German 5-year note was failing to make lower lows in the yield. At the same time, the US 5-year note was making a lower low. Okay, and then we saw both yields increase together. And here the high, you saw an inability for the US to trade higher in yield, while the German yield went higher. And you can see there was the shift in the major market sentiment. And that's really what this is measuring, market sentiment, because you're chasing the yield, okay, and the market's always going to seek yield. Okay, so if the yields are increasing, that's going to be bullish for major currencies, and it's going to be bearish for the dollar, and vice versa. And we've seen the same thing here in this April 2010. Okay, the US 5-year made higher highs, while the German 5-year note was unable to make equivalent new highs. And there was your shift. And notice this is happening March, April time period. And we just recently, at the time of this recording, also had another divergence, which is a continuation of this longer term downtrend in the yields. And again, here is a 10-year comparison. We're going to compare the German, which is the orange, the UK's green, and the lighter orange is the US 10-year Treasury note. You can see that same thing happening here, where the German was making higher highs, while the US and UK 10-year notes were failing to make higher highs in their yield. And the same thing is also that low that was formed in the fall of 2010. We saw the German 10-year failed to make lower lows in yield, while the US Treasury made, on its 10-year basis, made a lower yield, and the UK failed to make a lower yield also, and then that was your sentiment shift to bullish, and that would have been looking for buy programs on major currencies and sell signals, okay, in the dollar. Okay, in other words, the dollar would have been declining all during this period here, and at this point where we saw a major shift, okay, and the yield diverge, the sentiment now was going to send the dollar bullish, and then major currencies on the foreign would be declining. So that would be a risk off scenario here, or a sell program from Forex, and this is a buy program, okay, where the current foreign currency markets would be rallying, and the US dollar at this time period would be declining, Okay, so it just basically think in terms to make it real easy for yourself. When the yields are going up, the foreign currency markets should be trailing in sympathy, okay, because they're going to chase yield. And as the yields drop, foreign currencies are going to chase that down as well. There won't be any demand for that foreign currency, and there'll be a flight to safety in the form of going back to the dollar and buying bonds. Okay, so again, there's an inverse relationship between the bond market itself and the yield. As bonds would go up, the yields would drop, and vice versa. Okay, so um, that's basically the panoramic view of a risk on, risk off scenario and determining buys and sell programs on the daily basis. And this is one really strong, powerful way of keeping yourself in sync with the macroeconomic view. And you don't have to go through all this economic data. This is visual for you. You can see it happening. Just every 3 to 4 months, just look for a shift to occur. And when you start seeing these things occur on the yield, okay, that's when you want to be looking at your price charts and looking for maybe some top formations and some reversal scenarios, okay, and same thing in here. So we're using seasonal tendencies, cyclical analysis, and the yield analysis, where the market will always seek yield, and if yields are dropping, that's going to be bearish for major currencies and bullish for the US dollar. Key support and resistance. You got to know your key levels, guys. If you don't have a firm grasp on support and resistance, all this is going to be a waste of time, because none of your signals are ever going to confirm entry or exit unless they get to one of these key levels. The cornerstone to your success in trading will be your patience in determining high time frame key support and resistance levels and waiting for the setups to form at those same levels. Once you have directional bias based on the major market analysis, you identify key price levels from the 60-minute chart up to the monthly, nothing less than a 60-minute chart, and ideally the daily basis is optimal. Determine monthly, weekly, previous days, session highs and lows, as well as pivot levels and Asian range highs and lows. Market sentiment. You have to avoid the herd mentality. If everybody's doing it, it's probably not a good thing in the futures market or Forex. It's usually probably petered out. So you want to be looking to trade against the majority. Now, when deciding to take action in the market, it is important to remain on the side of the market that is the minority. Looking for trades when the market is by all appearance bullish when you want to short is ideal. And you might have already guessed it. When it looks bearish, do your buying. This might sound rather obvious and elementary, but consider how little actually followed this mindset. Consider the intraday Judas swing, for example. This is a sentiment play by all standards, and it's used to quantify an entry in the opposite direction. Market structure. Hunt intermediate term price swings. If you find all of your trading occurring at long to intermediate term price swings, you're going to find that your trading is absolutely mind-blowing. The ideal setups for trading low risk, high probability swings is to limit your consideration to only trading the intermediate term highs for shorts and intermediate term lows for longs. Taking short-term scalps and or day trades in the same direction is advised. Your trading plan is not to capture every move in the market, just the easy, low-hanging fruit. Using daily, 4-hour, and hourly market structure and nesting fractals can be a wildly profitable price action approach. This is my core price action concepts. Open interest and premiums. Now, open interest reflects smart money activity. Now, the open interest is basically only going to be found in the futures market. And the open interest in, for instance, this example here. Okay, in this example, we're looking at the Swiss franc, and what I've noted here is that price had ran up. It's been in an uptrend, and we moved into a trading range. Okay, and if you look at the circle here, that is open interest. That cumulative line that goes along and all of a sudden drops off precipitously, drops straight down. Okay, that is open interest declining while the market is in a range. What do you think that translates to? Well, this is a concept that I adopted from Larry Williams, and it still serves me well today. The open interest, while in a market consolidation or range, can tip the hand of the smart money if you understand what to look for. If the open interest drops off 20% or more rapidly, this is attributed to commercial short covering. If open interest increases 20% or more rapidly in a consolidation, this is commercial short selling. Commercial traders are the largest hedgers in the marketplace. And when you hedge, you're essentially shorting the market. You're selling something you already have. So if open interest declines, that means that they're lightening up aggressively on their shorts. Why would they do that? Because they anticipate price going higher. When you have a premium in the futures contracts, that means the nearby contract is selling at a higher price than the next month out in the future. That is a premium. Okay, that means there's a high demand for that particular commodity or currency. If you see open interest dropping off in that scenario, this is a near perfect trade scenario. You need to be buying. And as a result, this was a mega trade. This is in 2010. If you look at your charts around the 4th of July in 2010, you can see how in the FX market, the pair for the Swissy fell out of bed like a rock. This trade in the futures market actually moved 2,300 points, and it did less than half of 2 months. And the open interest dropped while in the range. Its support at 118, and it was in an existing trend already. And that's an absolutely mind-boggling profit. And if you have that type of scenario unfold in the marketplace, and you see a couple of these happen a year, you can really absolutely catch some explosive price moves. So I would counsel you to look at open interest in the futures markets on the pairs that you trade. The Swiss franc is an example here, but it's not limited to that. You can use it in the dollar index. You can use it in the Canadian dollar, Australian dollar, British pound, Japanese yen, and even the euro. Higher time frame directional bias. Maintaining a focus on the weekly, daily, and possibly the 4-hour time frames will keep your trading in the highest probable direction. Look for support or resistance on these levels to determine where price is trying to reach to. If price is trading lower on the daily, look for an old low or high in the left side of your chart to determine if there is time and price available for trade given that direction. Reverse for looking for buy setups. The main point is to keep the higher time frame in your trading. It really does pay off. General market, risk on or risk off. You want to start with the interest rates. Are we seeing yields dropping or increasing? Is there weakness or strength in the stocks, commodity, and treasuries? Is gold and or oil giving you any clues? Is the dollar index confirming recent highs or lows compared to the interest rates? Are there any market reports due that might change the current market tone? The more the other asset classes confirm or negate your trade idea, the better. Risk off, dollar rallies. Risk on, it slides. It's that simple. Anticipatory stage of analysis. This is the stage of analysis where you will spend the majority of your time. It is on the weekly and daily time frames. Since the trades are based on these higher time frames, there might be a few days or so before a trade actually sets up. But don't worry, that's a good thing. You want to track the interest rates. You want to be paying attention to COT, commitment of traders reports, major market indices, seasonal tendencies, key support and resistance levels, and intermarket analysis with correlated assets. This stage of analysis is the foundation to your successful trading career. Execution stage of analysis. This is the stage of analysis where you hunt setups based on the insights and conclusions you arrived at in the anticipatory stage of analysis. If risk is on, look for setups to buy currencies and confirm these setups with higher moving or poised to rally stock indices, CRB, oil, gold, and SMT concepts. If risk is off, look for setups to sell currencies and confirm these setups with lower moving or poised to decline stock indices, the CRB index, oil, gold, and SMT concepts. Management stage of analysis. This is the stage that requires your concepts for trade management on open positions, the management of stop loss orders, limit orders, initial profit objectives, and scaling later portions. Your trading plan must have clear concepts and techniques for the process that you will adhere to when managing open positions. This stage of analysis is crucial for consistently and having longevity in this career. You can find wonderful setups, enter at optimal entry points, and still mismanage the trade. And in this stage, you will find results bring with it loss and regret if you do not manage your analysis correctly. Reactionary stage of analysis. This stage of analysis is seen where your trades are open and you suspect or clearly see reasons to collapse the trade and cut your losses or take what profits you have open. There must be clear parameters in your trading plan that will invoke an immediate trade termination and abort on your original trade idea. This might be a result of a report or news event, global catastrophe, and or you realize you're simply human and essentially wrong. Imagine that, making a mistake. The documentation stage of analysis. This stage of analysis is where you record in your journal what your trade idea was based on, what tools you used and why, screenshots and how you felt going into the trade, while the position was open, and what made you nervous. The results of the trade should be documented and reflection on the trade plan and was it adhered to from the beginning to end. Document any lessons learned from the trade and what you would have liked to have done differently. Determine what leverage and or lot size your next trade will be using. Keep these records and refer to them when you experience a period of drawdown and or a string of losses. It will remind you that temporary losing streaks come and go.